Hello and welcome. My name is Simon French and I'm Chief Economist at Panmure Gordon. Today we're going to take a look at what the prospect is for global equity markets into the second half of 2020. One of the real challenges facing investors is that the real economy, almost around the world, has seen an unprecedented collapse, the kind of collapse in output we haven't seen outside war times for about 100 years. And yet, equity markets around the world have rallied from their mid-March lows, and in some geographies, including the United States, are now above the level they started the year at. So is this sustainable? Clearly, equity markets, investors historically have been forward-looking, and they're anticipating a rebound in economic activity from the lows seen in April time. But there are risks on the horizon. Some of those risks need to be summarized in order to understand whether to buy in at what are quite stretched earnings valuations at the moment. First obvious challenge is whether the economic recovery will be a straight line from here. From the almost complete lockdown of a number of major geographies during Q2, it's expected that with social distancing measures in order, the economic activity rebound will be steady, but it will be upwardly sloped back towards output levels seen at the start of the year. But clearly that is conditional on not having a secondary lockdown. And some of the evidence from around the world in terms of states, regions, cities that have started to ease lockdown restrictions is still mixed at this point. And clearly retracing some of those lows in the equity market seen in early March, while not our base case given the amount of liquidity north of $4.5 trillion being introduced by central banks, clearly that is one of the options or one of the outcomes that investors must try and price. Now, the second major issue, of course, is what long-term economic damage to earnings will take place. We've seen unemployment spike quite aggressively in the United States, but start to come back as the economy was reopened. But what long-term scarring will take place? And the scarring in the real economy translates to corporate earnings and therefore sustainable valuations. And clearly it is easier to fire workers than it is to hire workers. So we don't expect the same rapid retracement of employment back towards sub 4% that we saw, or unemployment back to sub 4% as we saw at the start of the year. But clearly in an environment where there is a fast recovery, households will start to draw down on their precautionary savings built over this period and boost consumer spending. So there's a multiplier argument, an economic argument for a more positive earnings story during the second half of the year. But wrapping that all up, equity markets on traditional valuation measures look very keenly priced right now, but most investors have concluded that governments backed by their central banks are prepared to inoculate the economy in the short term, not worry too much about moral hazard, and provide almost limitless amount of liquidity and keep yields low. And in that environment, equity prices are more likely to remain around their current levels than retrace their Q1 lows.